Bitcoin is correlated to global liquidity and those tightening credit conditions, and it starts to fall for the same reasons, then the miners who need that debt in order to make their AI economics work, they actually end up as bigger sellers of Bitcoin than they otherwise would have been. And that leads to this vicious cycle that I think we're seeing right now.
This creates a dangerous double whammy situation. If credit conditions tighten due to doubts about the return on AI investment and Bitcoin correlated to global liquidity starts to fall for the same reasons, the miners are forced to sell more BTC to meet their debt obligations. This is the vicious cycle Siegel believes we are witnessing now. While funding is still available, spreads are widening, making global liquidity a yellow light, mixed to bearish. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
We generally look at Bitcoin allocation through three lenses. There's global liquidity, where you can see that Bitcoin's, really only persistent correlations are a negative one with the dollar, the DXY. And so issues around risk appetite, leverage, and deleveraging, this is kind of the 100,000-foot topic that has moved Bitcoin since COVID more than it used to pre-COVID. And unfortunately, the Bitcoin miners are kind of at the center of this because the recent de-risking and tightening of credit conditions is, in my view, predominantly because of all the debt that the hyperscalers, companies like Oracle, are raising to build out their AI capacity. The Bitcoin miners are the tip of the spear on this because they are actively repurposing their Bitcoin operations to address this market opportunity, but it requires a lot of CapEx. The CapEx is debt funded if they're lucky, convertible funded, equity funded, or frankly funded from Bitcoin sales. And you can see that the miners through October were really pretty aggressive sellers of Bitcoin in order to fund this AI build out. And so you get into this kind of double whammy situation where if credit conditions are tightening because the market is doubting the return on investment from the hyperscalers, and if Bitcoin is correlated to global liquidity and those tightening credit conditions and it starts to fall for the same reasons, then the miners who need that debt in order to make their AI economics work, they actually end up as bigger sellers of Bitcoin than they otherwise would have been. And that leads to this vicious cycle that I think we're seeing right now. So long answer to your question, the first lens that we look at it through is global liquidity. And I'd say there, the evidence is mixed. These projects are still getting funded, but spreads are widening and it's a more questionable outlook on that front.
What are the other two? You said there's three.
Yeah. So the other two, the second one is leverage in the crypto ecosystem. There, we describe it as a green light, right? We had a washout in the middle of October, which brought leverage levels in crypto down. Funding rates have collapsed. There was another, I think it was 1.7 billion of liquidations over the last 12 hours. So we're not seeing optimism in the crypto leverage market. I would tick that one as bullish, right? The first one would be kind of mixed to bearish. And then the third one is on-chain activity. What's happening with transaction fees? What's happening with on-chain addresses, number of transactions? That one we would describe as negative.
Siegel revealed his tactical response to these mixed signals. He, through the on-chain economy ETF he manages, sold about 15% of their Bitcoin mining position 2 to 3 weeks ago. This was a preemptive move to de-risk based on optimism in the mining sector and the initial signs of credit tightening. They have not yet redeployed that capital.
People not making that call. For me personally, in the on-chain economy ETF that I manage, we sold about 15% of our Bitcoin mining position about 2 or 3 weeks ago, just noticing a lot of optimism and the beginning of this credit tightening situation. And the Bitcoin miners had driven a large percentage of our gains. And so it felt prudent at year end to kind of de-risk that a little bit. We have not yet redeployed that. There are some levels for Bitcoin that I'm thinking about. One of them is in the kind of 77, 78 range. So what that would be a 40% decline from the peak. And last cycle was an 80% decline. Since then, Bitcoin volatility has fallen by about half. So for my simple view, if volatility is down by half, then maybe the correction is half as big, and 40% feels like a reasonable chance to take a shot on a risk reward basis. Mm-hmm. It has the added benefit of also being the breakout of the post-election
69,000.
It was in mid 70s where we really got that election day move. Mm-hmm. And then April of this year, we retested that high 70s level. So there's a fair amount of, I think, technical support that has been built at that level. And then below that, a lot of folks are looking at the 55K level, which is the 200-week moving average. Mm-hmm. God forbid we talk about if we had another 80% decline, then you're back into 27K or so, which is actually right at the level when BlackRock filed their S1 for Bitcoin ETF. Mm-hmm. So that would wipe out all the ETF gains. I really think that's unlikely, but the 40% decline, the high 70s, that feels like a good shot to take a stab with positive risk. And Bitcoin mining machines are selling well. This DRAM business, the memory building blocks, Bitcoin mining has been kind of mid-single digit percentage of the DRAM industry. So on the margin, it moves the needle, but it's not the dominant force. But when you combine the impact that AI is having on this business, it actually has really tightened the supply demand dynamics. And a company like Hynix sells at something like 5 times PE. So that's an example of like a 1% position that we think is peripheral to digital assets, but riding some other structural tailwinds as well with really good valuation. So I think that's one example. I think there's 2 major things that are going to turn around this market. One would be top line revenue surprises from OpenAI. One of the big controversies in the market is there going to be a return on this AI investment? In my view, a lot of it won't be seen except on the cost side, right? The math of taking costs out of your business flow more directly to your earnings per share than adding additional revenues. That's kind of a dystopic view of the economy that a lot of folks are not quite willing to embrace. And instead they want to see top line revenue momentum from OpenAI, specifically on the enterprise front. So they announced a big deal with Target this week, where Target is going to integrate OAI infrastructure into their app and their store assistants and the checkout process. But that's one deal. It's probably a 9-figure deal, but it's one. And given that OpenAI is private and the information doesn't come out of there in a standardized way, that's an overhang, I think, for the markets until we get more clarity there. And then the second would be the Fed cutting rates. Obviously, a lot more skepticism has now been built into the markets, and there seems to be a really perhaps politically polarized view on the FOMC board about rate cuts in December. So I think those are the 2 things that would turn around the liquidity, the first of the 3 elements that we look at when analyzing Bitcoin.
And when you start looking at some of these other public equities, so you've got hardcore things like the Bitcoin miners, but there's stablecoin provider, Circle, you've got Gemini, you've got Coinbase, like you start to get infrastructure, maybe some of these other themes. How do you look at some of those companies?
Yeah. Well, let's take a company like Circle. Came public in the middle of this year at $30 a share. It hit 300. So at 300, we were out, right? And there was this enormous IPO lockup that actually just hit in the last week or 2. Stock's now down in the 60s. I would argue that if liquidity stays tight and the macro environment is a little trickier, which is what the equity market seems to be discounting, then competition in the stablecoin market may actually be less than people think. It's going to be really helpful for Circle to be a public company, even if the stock price is $40 or $50, with the IPO lockup selling in the rear view mirror. They printed a pretty good quarter just last week. That's an example of a name that had a lot of euphoria that made it unreasonably valued from our position. Now we're kind of going through that trough of disillusionment. Meanwhile, they actually are taking market share. So I wouldn't be surprised to see a name like that be a higher weight in our portfolio going forward. And just going back to the Bitcoin miners, I think one of the really interesting things that we're going to learn from this shakeout is how much the cost of capital matters. Almost all of these companies have raised money in the last 3 months to try to build out their AI infrastructure. It's very capital intensive. And we're starting to see a dispersion where a company like Cypher that just announced an expanded deal with FluidStack backed by Google this week, and they're able to raise straight debt now to build this out, whereas a smaller company like a BitDeer had to do a convertible, CleanSpark had to do a convertible, much more dilutive events. So that cost of capital could start to diverge, and we could see some more kind of winner take most characteristics emerging out of the Bitcoin miners, which would tell you, buy the big guys really with the capital that you have for the space. Bitcoin mining was really around hunting out the cheapest electricity and bootstrapping your way to domination in that individual region. But it was very hard to get economies of scale because Wall Street wasn't funding these businesses. That's changing now with the intersection of AI, where TeraWulf, Cypher, they're able to raise debt, and it's junk rated, but it's a step change in terms of the impact on minority shareholders. I still think it's a regional business largely. You've got Iron and Cypher down in Texas. You got TeraWulf up in New York. You've got Bitfarms in PJM. They're not stepping on each other's toes too much yet, but the signs are on the wall that they're going to start to. So TeraWulf was hinting last week that they're going to start regionally diversifying, maybe following, they already did in Texas, in fact, following some customers to Texas. So I think a little more benefits of scale, but like the utility business.
Finally, when assessing public digital asset equities, Siegel notes the rapid correction of companies like Circle post-IPO lockup. He argues that in a tighter macro environment, competition may decrease, benefiting established public companies like Circle, even at lower valuations. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.